Hello, everybody. This is John Blank. About to get off on my part 3 of emerging tech discussions. First of all, the disclosures. The views of John Blank, PhD, are not necessarily the views of Zacks Investment Research. All right, so we're off on the 2022 strategy set, part 3 on emerging tech. We will learn about the other major emerging tech ETFs. Part 2, as you know, was the ARK funds, the 6 funds that Cathie Wood has put together. This will not deal with that. This will deal with a lot of competitors that are out there. I did this on Monday, the 31st of January, 2022. All right, so off we go. All right, first thing I want to point out is we've got well-known emerging tech ETF fund families. I pulled this together over the weekend, but this is actually October 18, 2021 data. So this does not include the assets under management after the correction of growth stocks. So this is pre-correction. It's kind of back in the fall when things were looking pretty rosy. So first thing to notice is number 1, 2, 3, and 4 are the really big asset managers. The biggest, of course, is iShares with 2.4 trillion under management. Today, we're going to look at 2 of their emerging tech funds. One is ticker IEFN, which is their Evolved US Financials ETF. Evolved US Financials is a word that I would couch because they actually carry some of the really big tech or financial names like Goldman and Bank of America and things like that. So they're assuming the evolved emerging technology is happening within the major banking system with IEFN. Typically, this is the case with the major ETF providers. They will have a lot of very, very big stocks in them. IETC is the iShares Evolved US Technology ETF. This is more directly involved with the emerging tech space, but as you will see today, again, very large stocks. A lot of the mega caps are in here. And this is going to be very typical for these major funds. Number 2 in this space is Vanguard, of course. They have 2 trillion under management, just behind iShares. Number 3 of the spider funds, those are 1 trillion. Number 4, and we'll get into a lot of these today, is Invesco, which is at 371 billion under management. The 3 that we're going to look at is the QQQMs, which is the Nasdaq 100, top 100. The QQQJs, which is the Nasdaq's next generation 100, which is a smaller cap version below the M's. And then there's PNQI, which is the Nasdaq Internet ETF. And what you're going to find out is the Nasdaq 100 and the PNQI are, again, borrowing a lot of stocks. So the first point I want to make about any ETF is the fund family really matters because, like we learned in Cathie Wood's experience with these, are no different. Fund families will borrow stocks in their family universe that have been vetted and are put in one fund and put them in another fund. So a lot of times they'll be similar. Now, further down the list, number 11 in size of ETF manager is Global X. Their first ETF was coming out in 2009 on this, quote, thematic growth theme. So this is really an interesting group. They were bought by Seoul, South Korea-based Murray in July of 2018 for 488 million. So this group actually, as you notice, is at number 11 in assets under management. It is actually slightly ahead of ARK back at October 18. So you may have not known of Global X, but it is actually as important as the ARK funds for this space. Now, 3 names and 3 tickers that we're going to look at today: bots, robots. That's their, BOTZ is robots. That's Global X Robotics and Artificial Intelligence ETF. SNSR, Sensor, which is Global Internet of Things. Typically involves sensors that are embedded in equipment. And then AIQ, which is artificial intelligence and tech. So this is their area. They do a great job here, by the way, and you're going to see some really nice names in this space. Like number 12, as we've already talked in part 2, we will not talk about ARK today. Number 20, KraneShares, 11 billion under management, of which is the one we're going to talk about today is KWEB, which was started in 2013, had in October 6 billion in assets. That is a fairly large fund for the China Internet, the CSI China. So this is mainland China stocks, KWEB. Number 47 is, this is a much smaller ETF fund, only 2 billion under management. And They launched TNHQ with only 40 million in it. TNHQ is the ROBO Global Artificial Intelligence ETF. And as you're going to see is TNHQ is actually another very good emerging tech holding. So what I point out here on this first slide is that you've got the major funds with the big stocks, and then you've got a lot of people working hard that are not as well known to you. So this is something that's really a value in this particular discussion, is to know both of these names and look at them both together. So first off, let's do the Invesco. Okay, Invesco is the big hitter. I've pulled this together with Zacks Research Group, and on the right-hand panels, you're going to see the Invesco PNQI at the top right and QQQM at the bottom right. Oh, I'm sorry, I got this backwards. This is PNQI at the top left and QQQM at the bottom left, and iShares on the other side, which is IETC and IEFN. So the main point I want to point out, let's look at the Invesco ones on the left, and you're going to see that first off, the PNQI is really good for revenue growth. The other thing to note here is what's called the reinvestment rate, which is 13% or so, 12 or 13% now, moves around a lot over the last 10 years, but basically is pretty low. And what you can learn here is that this is going to be the case for companies that are not reinvesting much in their businesses. Now, down below, the Invesco Nasdaq 100 ETF has a reinvestment rate of 49%, so much higher. So, but the main point I want to point out to you why you like ETFs is you're trying to drive up over time some accretive fundamental value, and that first revenue growth line in both of these stocks for Invesco is well done. That's what you want to see. Now, on the other side, we have the iShares Evolved US Tech and the iShares Evolved US Financials. So first off, I want to point out that the bottom chart, the financials really took off in 2016, 2017. They haven't done much since then. And you're also going to find out that the reinvestment rates are very low in this area because they are giving you a lot of cash back to their customers. They're not actually investing a lot in these businesses. So this is, your Wells Fargo's, your Bank of America's, Goldman Sachs' of the world. Now, if you look it up, the iShares Evolved US Tech, you're getting a very different story. You're looking at reinvestment rates that are 51%, the highest of any. So these are the businesses that are really growing and they're using the cash to put it back in the business. And you want to see that investment rate growing up, and that's what we're seeing here. Right here, we're seeing that investment rate go up. So this is great stuff. You want to see this, and you want to see this, that's the Evolved US Tech experience. So by and large, we're learning that tech and financials, just by looking at this, are very different things. And also we're looking at the Invesco world as really pretty good, well-constructed funds. You can't go wrong here with these big names. All right, so let's go down further into the ROBO ETF. And this was written by one of their people, William Studebaker, on 18th of January, a couple of weeks ago. And what he wants to point out is that, this was launched in 2013, like the Kathy Woods Fund back in that 2013 era. They've added two others, the TNHQ and then the Global Healthcare. So they've got three funds, and they're designed, quote, to provide a high quality bias and cyclical exposure to tech, such as factory automation. So they really do a good job with high quality bias, meaning the profitable companies that are growing well. So they know that some of these high tech values are 30 to 50% off, but actually Robo is only off 6% so far in 2022. That's pretty impressive, folks. When you have the Nasdaq down 11%, these guys are in the spot that actually working well. So the ROBO Global ETF finished 2020 up 15%, which is very low relative to the S&P, but it may now be where it needs to be. And this is basically, again, they're trading at 5.5 times enterprise value to sales. So they're looking at much more valuation driven as well as profitability. And that's something that worth thinking about in this environment. All right, so let's go to the shares outstanding of these all these companies. On the left-hand side, I have the old Ark story. RKK, RKW, F, Q, G, and X. As you can see, the percent change in these funds over the last year to 27th of January, poor, 20% to 40% down. Again, not very impressive performances is a story we've already covered. I only put them up to show you the difference on the other side of the ones we're looking at today, the PNQI, the BOTS, the Sensor, IETC, AIQ, TNHQ, the QM and the QJ, the IEFN and the KWEB. Now, first off, I want to point out that the outperformers this last month are KWEB, the QMs, and the financials. Of course, of all financials, we know the financials have held up well. That is where the space has been strong. But the question you have to ask yourself is it now time to look at the PNQIs, the BOTS, the Sensors, the IETCs, and the AIQs for a play in this space? There's a good answer to be said here that those are ETFs you should be looking at right now. Now, obviously, look at the very top chart here. You can see that we're looking at, this is the KWEB, and that really tanked over the last year. So the one thing you have to ask yourself is if KWEB is actually where you want to be now, if the Chinese tech scene gets some positive sentiment from the traders in the next year or so. But otherwise, looking at PNQI, BOTS, Sensor, IETC, AIQ, these are TNHQ, these are all good names to look into right now. And I would recommend that you do so. All right, so I went ahead and did this. Here's the market capitalizations of very well-known ETFs. And I looked into, again, at the top, PNQI, that's where the red arrow is. You can see that up here. And you can see that PNQI, like I said, this is Invesco. And you're going to see these big names in here: Facebook, Amazon, and Netflix, Microsoft. So these are big, big companies. PNQI, Nasdaq Internet. Don't get confused that this is small companies. They're very large. Now let's look at Sensor. Sensor, did it make sense to call it the Internet of Things? Well, actually it did. Very good job here. STM is ST Micro. It's the #1 ranked chip stock right now for us, 45 billion in market cap. Dexcom, which is, again, providing medical devices that have sensors in them, heart valve or heart, valves and things like that. 52 billion under management. And Sensata, it's based in Massachusetts, which is an industrial sensor company, 10 billion under in market cap. So these are their big players. Those are all Internet of Things. Internet of Things means sensors talking to other sensors and communicating. So that does make sense. Sensor is organized there. Now let's look at TNHQ, which is the ROBO, that small group, Global Artificial Intelligence. So here you find the Lumina, which is the analysis of genetic variation. They made almost $6 a share in 2020. That's a 59 billion market cap stock. So what they're doing there is using artificial intelligence. This sense is using supercomputers to study genetic variation. FICO, #2 ranked stock right now. This is Fair Isaac, 12 billion market cap. Again, very strong use of big data to study financial reports and things like that. So again, that's artificial intelligence taken into the financial world. Baidu is China's search engine. So again, a $52 billion stock. What Baidu does is get information on the Chinese consumer and the search engines that are out there in the Chinese world. So this is, again, you can see all these funds are really nice. And one thing that you find, I think, is important is NVIDIA can find its way into a lot of these funds. And this is different than Kathy was. She never bought NVIDIA or Facebook or Amazon or Netflix. She stayed away from these major market cap stocks. That is something different about these stocks. So let's go to the next one. Okay, ROA, of well-known emerging tech ETFs. These are the return on assets. Return on assets, another measure of profitability. I'm looking at from 2016 to 2017 to 2018 to 2019 to 2020, 21. So we're looking back over 5 or 6 years. And I circled 2 of the ones that I want to look at again today. First, BOTS is the red one. We talked about BOTS before, and as I mentioned, NVIDIA is in here. Look at how strong NVIDIA's return on assets are every year. Very strong stock. ABB, Azure Brown Boveri, which is a Swiss power and automation company, not quite as strong as NVIDIA. NVIDIA is very impressive as a company, but still positive and good. And then the Intuitive Surgical, you can see here, again, really strong return on assets, but not half of what NVIDIA is, but still good. So you can see here that they definitely have a lot of different industry sectors in returns, but by and large, the return on assets are very good. Now let's look at Sensor. Sensor is not quite as good as the bots, but still quite strong, always positive. ST Micro, again, is a chip company that's doing quite well in this environment. Dexcom, we talked about, it's definitely improved. There's some negative ROAs back 5-6 years ago, but not now. And Sensata, the name you probably don't know, hanging in there, doing quite well. So if you look over at TNHQ, you can see, again, very strong return on assets numbers. And if you look below that at the QQQMs, there's Apple, Amazon, and Microsoft, and the QQQJs, which are names you probably don't know. Trade Desk is in there and some other stuff. So, but again, look at all the positive ROAs. Very hard to be complaining about this. So let's go to the very bottom one. That's KWEB. And again, while this is sold off a lot, JD is coming back, and Baidu and Baba are very strong return on assets. So again, like I said earlier, that may be where the play is in this space. So let's go to return on equity and return on capital employed. Again, I'll leave this up shortly. You can stop the recording here and look at this. Mainly why I put it up here is just so you can notice that the return on equities are significant and improving on nearly all these tickers. That's all you want to pick up here. But study this for understanding these tickers. It's very important to do that. All right, so the Zacks rank, I'm in the VGM scores, our long-term scores. These are being applied here. The Zacks rank is in this column on the left-hand side of my screen, and then over here you have the value growth and momentum scores. So those are longer-term scores. What I want to point out here is Global X's artificial intelligence and tech has done a really nice job picking stocks that have impressive earnings estimate revision performances. NVIDIA, Qualcomm, Apple, Cisco, Accenture, ACM. These are names that are big companies, but they're doing well, and they pick the stocks well. So that's important to understand here. Take a look at this, stop the video and take a look at this chart. All right, EPS estimates for other techs. Again, now let's get the PNQI and the QQQMs. What I want to point out here is just what I said earlier, is that PNQI and QQQM are the Invesco family. And yes, the names are very similar. Facebook, Amazon, Netflix, and Google for PNQI, and Apple, Microsoft, Amazon, Facebook over there. So yes, they do borrow names. You've got to be aware of that. When you buy fund families, you've got to make sure you don't buy stuff that's basically the same, because you'll over-concentrate in some positions. All right, earnings growth. Again, stop the discussion here. You can get through this on your own. I circled the surprises on the left and the surprises on the right for these groups, and we've got 10 different ETFs to look at. But you can see again that there's very strong performances on a lot of these companies, and pretty strong performances that you can rely on over 2016, 2017, 2018, 19, 20, all the way to 21. So take again, stop the video and carry on. All right, so here's another thing to look at in these emerging tech stocks is the big names. And one of the things to focus on is earnings growth. And we've pulled together a lot of different names. You can see the tickers: Adobe, Baba, Intuitive Surgicals, ISRG, ONS Semiconductors, Tesla, Google, IBM, Google again, NVIDIA. And then at the bottom, you can see some of the evolved financials: Goldman Sachs, Schwab, and Baidu. So all over the place here for studying growth rates, but look at how strong some of them are. Like on Semiconductors chart from 20 to 2021, you can see that chip supply shortage really playing out for them. Tesla with 35% growth rates in that second chart, but strong across every year, doing 38% annually. They really do deliver. You can see how stable that is at a high level. That's impressive. Now look at Baba. Baba at the top is at 15.5, which is still good, by the way, but it really did peak in 2018 at 35%. It has gone down since then. So Baba, again, has kind of gone back to the median. They're not as strong as they used to, but still quite strong. Intuitive Surgical, not only 10% growth a year, not as strong as you might have expected. It kind of fluctuates around a lot. So Again, this is a great chart to stop and look for stories that are attractive. For example, looking at Google, obviously, and in the second panel and the third panel, they look pretty good relative to their other companies. So again, stop the chart, look for strong earning growth companies at the top. The other thing to look at is price to earnings growth when one looks at valuation opportunities. Obviously, the lower the price to earnings growth ratio, the better it is for you as an investor longer term. So names that come up that are actually quite attractive around the one level: Facebook, Google, Qualcomm, and Baba and Wells Fargo. So those are names from an investor perspective. Not only do you want to know that about the ETFs that have them, but the stocks themselves. So that is all good. Again, stop the video, take a look at these names over here. Those are the PEG ratios. Low PEG ratios like Google are what you want to see. All right, so on to revenue. Forward 12-month revenue of the same names. I just want to point out here, again, if you're looking at strong businesses that are growing revenues, this is another source of strength in the marketplace. So we're looking here for the top levels of growth in revenues. At the very top level, it's probably a better name than the lower levels. And again, surprisingly, Baba is at the very top of the first chart. Google, again, comes clean. And you can look at Tesla, the green line in the second chart. This is impressive. There is why Tesla keeps going. It's proving up so strong relative to any other revenue growth thing you're looking at. And you've got to respect it. Now remember we saw on before, but now on, in a revenue growth perspective, doesn't look so good. So on clearly is about the chip shortage. It's about the revenue growth not really being the story here, but the pricing, that they can get so much more pricing out of the chips they do produce during this chip shortage, right? That's the earnings growth. But the revenue growth, not as great as Tesla. Obviously, but Google, again, got to be aware that Google and Baba, really strong businesses, search engine businesses, those big internet businesses that get out there and dominate the world. They do actually deliver forward 12-month revenue growth. So let's go to the final one. That's it. Takeaways I want you to pull together for today. Outside of RKK and these emerging tech ETFs we investigated, we do see mega caps other than Tesla, and we do see semi-chip companies. This is what Cathie Wood didn't touch. She didn't touch the mega caps and the big semi-chip companies. So you're getting exposure from these emerging tech companies by that. By the way, these are really not emerging tech companies. I guess their tech is evolving. They merged long, long ago. Now, inside ARK, as I point out, you do not have the mega caps for chip companies. You didn't go there. I truly think the likes of NVIDIA are disruptive and very innovative. I'm surprised that NVIDIA didn't find its way into ARK. But you can get exposure to NVIDIA in these other areas. And again, we pointed out that the alpha generators in 2021 for the ARK funds, 2020 and 2021, were Tesla and Bitcoin. That's probably not the case here. And as you see, none of these new emerging tech funds are really investing there. These emerging tech funds are doing careful, well-selected, fundamental analysis, and that may well be where you want to be for the next up in the leg after this Nasdaq stock market correction. So take a look through this thing, play it back, stop at these charts, and get a feel for how you can invest in this area. It's gonna get better and better. You're gonna find more and more names that are gonna work. And I really strongly endorse this space right now after this correction.